Coming up, the auction market cools, oil below 80 US, and the outlook for the Australian share market. That and more next. Hi everyone, welcome to the SBS on the Money podcast for this Monday, the 22nd of June 2026, a day where the Australian share market fell, but only just. The S&P ASX 200 down 0.14%. We'll have the details with Mark Gardner from MPC Markets, including what he is telling his clients in a few moments. But first to the property sector, where Cotality says the preliminary auction clearance rate has tumbled to its lowest since April 2020. At 47.7% nationally. The market is softening, with around a quarter of scheduled auctions withdrawn last week, while nearly half was sold before going under the hammer. So what do buyers and sellers need to know in this market? For that and more, I spoke with Cotality Research Director, Tim Lawless. Tim, with auction clearance rates at the lowest since April 2020, what's driving this and what does it say about the state of the housing sector?
So there's a lot of things behind these numbers. A 47% preliminary clearance rate is very low, but expected to be revised lower. I think normally we see about a 5.5 percentage point revision downwards from the preliminary to the final number. So clearance rates are probably more likely in the low 40% range now. The reasons behind this, Ricardo, I think come down to a whole bunch of things. We've been seeing clearance rates drifting lower pretty much since early March. So that aligns with interest rates rising, of course. It aligns with the crisis of confidence amidst the Iran war. And of course, also, we've seen a further slump post-budget. So I think there's a lot of things at play here, but each one of them are adding to the downside risk in housing markets. Typically, when you see clearance rates this low, it does mean there is going to be some downwards pressure on prices, which we're already seeing.
What I found interesting in your report, 23.6% of scheduled auctions have been withdrawn and nearly half sold prior to going under the hammer. So what does this say about the way buyers and sellers are feeling and perhaps the changing selling techniques?
Well, to see nearly a quarter of auctions withdrawn, these are auctions that were scheduled that simply didn't go ahead, probably suggests that a lot more vendors are now not getting enough registered bidders for the auction to be successful. So they're pulling the auction from market and they're not rescheduling it, which of course counts as a negative result in our methodology. And the fact that we're seeing a lot more auctions selling ahead of going under the hammer as well, I think also speaks to a lack of vendor confidence. So I think for a lot of people selling their property at the moment, if they get an offer that looks reasonable ahead of the auction, they're simply not willing to test the market under true auction conditions, and they're going ahead with that sale. I think it's just it really does speak to vendor confidence and the fact that we're seeing buyers becoming very much in the driver's seat now.
To what extent is it different or similar across the country?
It is quite different. I mean, the two major auction markets are Sydney and Melbourne, and that's where we see most of the auctions being held. Sydney had a 47% clearance rate over the weekend. Melbourne was at 50%. Go to somewhere like Brisbane, and about 15 to 20% of homes are taken to market by auction. So it's not quite as much of an auction culture. But the clearance rate was 33% in Brisbane. There was only about 16 auctions in Perth, so the clearance rate is just too volatile to be bothered, spending too much focus on. It moves around a lot, but I think we are seeing, listing numbers in those mid-sized capitals do remain very low. Perth is still tracking about 20% below the 5-year average for the number of homes that are on the market. Brisbane's about 5% below average. But go back to the end of last year, Perth was seeing about 50% fewer listings in the market than average numbers. Brisbane was nearly 30% below. So we are seeing a clear upswing in advertised stock levels, even in the mid-sized capitals. And I think for buyers, this is great news. It means finally there's a bit more choice coming into the market, less urgency in their decision making. Finally, buyers can probably take their time to deliberate on what is a very important and high commitment financial decision.
So combined, what we're seeing, and I know Cotality puts out property price numbers on the first of the month, but how likely is this to flow through to property price growth or lack thereof now?
Well, it's highly likely, and we do track the market intra-month as well. I was just looking at our daily index and looking at the 4 weekly change, which gives us a pretty good proxy for the monthly change in the market. Sydney's down just over 1% over the past 4 weeks. So continuing to gather momentum in its downturn. Melbourne prices were about 0.8% lower over the past 4 weeks. So again, not quite as severe as Sydney, but definitely building into the downturn. And those mid-sized capitals, they're still seeing values rising, but nowhere near as quickly. In fact, Adelaide's only up 0.3% over the past 4 weeks. Perth's below 1% for the first time in a very long time. So I think we're seeing increasing evidence now, Ricardo, that low clearance rates, longer time on market, a pickup in listing numbers is really weighing on value growth.
So with that in mind, what's your advice then to buyers and sellers?
Well, it's very different advice. I think for sellers, you need to be in tune with the market. You probably won't get the same price today as you might have gotten yesterday, especially in Sydney and Melbourne, where values are clearly going backwards. And at a time when there's increased competition to sell, not necessarily because there's an increased flow of new listings to the market, it's more about an accumulation of stock in the market. You probably need to maximize your marketing strategies as well. Make sure you stand out from the crowd. For buyers, it's probably a case of if you don't get the price you're looking for, go back and find the next one. Whereas a year ago, that simply wasn't part of the game plan. Buyers definitely would be rushing into a decision. Otherwise, somebody else will buy that property out from under them. So I think for buyers that they can negotiate, they can take their time. There's not as much urgency. But of course, I think for both segments, have a look at the actual local conditions. There are so many niches and complexity in this tapestry of housing markets around the country that each market will have its own personality, of course.
That's Tim Lawless there, the head of research at Cotality. From the property market, let's go to the share market, where the S&P ASX 200 fell 0.1%, with little lead from Wall Street given the Juneteenth public holiday at the weekend. Tech was the worst performing sector, driven by a huge 18.5% slide in Wisetech, which we'll explain in a few moments. Elsewhere, the miners fell, but the banks rose, and Ingham's lost 4.7%. It imposed a full lockdown across its WA farms after bird flu was detected in the state. For more, I spoke with Mark Gardner. He is the CEO at MPC Markets. Mark, so a muted start for the week for the ASX. US markets were closed at the weekend for the Juneteenth holiday. What's likely to drive investor sentiment this week?
Well, this week we've particularly got a lot of domestic-based economic information. We've got CPI on Wednesday and the trim mean from RBA, which is very important given Michelle Bullock's comments about, despite the fact the market has priced out any further rate hikes, that essentially if there was any further inflation, they're back on the table. So that could really pivot markets. We've also got our employment numbers on Thursday as well. There's not much in the way of economic numbers in the rest of the world, just some manufacturing numbers. Micron is reporting earnings on Wednesday night, Thursday morning, which will be pretty key for those software stocks. Semiconductor stocks that are been on an absolute tear in recent times. But apart from that, all eyes are going to be on the memorandum of understanding, and as it looks at the moment, of the 14 points outlined in the in the MOU, there's probably about four or five that will be fairly easy to get over the line, but there's probably more like 8 to 10 that are going to be incredibly difficult, with Israel and President Trump being consistent wildcards.
Oil prices are down, though, below 80 US for Brent. We've seen petrol prices now trading at below where they were before the conflict. We know the government is extending its fuel excise discount, but at half the rate, at 16 cents for another month. I mean, given the unnature of the discussions, though, in the Middle East, what can investors expect with that oil price and the follow effects to consumers?
Well, that 16-cent excise extension is more of just a gesture in a way. Obviously, the government copping a fair bit of flack on the back of the budget and the tax changes for investors, etc. So, it's a very small thing when it comes, and it barely offsets what flows back in once it expires. Where oil sits at the moment really is not that far away from where it was leading into the conflict. So, I think we were somewhere in the high 60s. And I don't think the market's effectively pricing in anywhere near enough risk that this could be derailed. I mean, you've got Israel, which could break a ceasefire at any time, which is a very conditional part of the ceasefire arrangement. And then, Iran could close the strait at any time. The US could claim to close the strait at any time. Trump over the weekend has tweeted some fairly, front foot or aggressive tweets towards Iran as well, and there's rumours that they walked away from the negotiating table at that point when he did that. So I think that energy stocks are not reflecting that risk at all to the upside. I think they're quite cheap at the moment. And I think the overall market is not anywhere near pricing in enough risk because if we see those oil prices go back, back to that $90 to $100 range, we're going to see extended inflation across the board globally. And we've already got hawkish central banks around the world. And you'll have a stagflationary environment where consumers are being hit with the discretionary budgets as pump prices go up, and inflation on everything from food to transport costs, etc. So I think we're probably just being a little bit too. I don't think we're being cautious enough here at the moment as to how this could just fall apart at any moment.
Any company news you're keeping an eye on today?
Obviously, the big story today was Wisetech, as the executive chair has been accused of further transgressions. Look, this is one in a long line over time. We had I think we had the federal police hit them for insider trading and raided their offices, etc. And there's been alleged sexual harassment claims pointed at him as well. For sort of the long-suffering shareholders, they've got a CEO in there now who realistically has been there at the company a very long time and is not really being allowed to just take the reins of the company. And there's been many examples in history where when a founder's left the company, like Technology One in Australia. The company's gone on to great things. So at 71, Mr. White's probably one of the older, heads of innovation and executive chairs sitting on a tech company. Shareholders are probably wondering, whether the company is far better off without him, remaining at the helm, and maybe this is the final straw.
Yeah, and on those allegations, there were reports today that he's at the centre of a police investigation. I actually reached out to the Australian Federal Police, who told me it will comment at an appropriate time. So that's all they've told me. Moving on, though, what are you telling your clients more broadly, and where do you see the opportunities for investors?
I mean, we've been on quite a few of the semiconductor stocks or the Philadelphia SOX index, SOX. And we're starting to take those off now, and we're sort of switching to those oil names I mentioned before, and just maintaining high levels of catch and trying to remain a little bit agile, because I think what you'll see, the inflation numbers still come through quite hot over the course of the next couple of months. We've been very piece on, piece off, agreement on, agreement off for quite some time now. And until it's done, I'm really not confident enough to say that we're going to have any further significant upside. I mean, the US markets had 11 out of the last 12 weeks, I believe, to the upside. It's one of the best runs they've had in nearly a decade. And despite the fact that we're great believers in this data center and AI thematic that's going on in the background here at the moment, and these chip stocks, we just, a lot of the spending around that, or over 50% of it, comes from about 5 or 6, hyperscaler names like the likes of Microsoft, Google, etc. If they pull back any sort of spending whatsoever, and it's only 5 of them that have to make that decision, not the broader market, that's going to filter down into all sorts of different industries, from the cement and the steel that's used to build the data centers, to the chip makers, to the memory chip stocks as well. So, whilst it is a booming thematic, and we do have long-term confidence in it, we are very high at the moment, and we haven't really had any sort of significant pullback, considering the geopolitical mess that we've had, and and other factors going on, like overvaluation just generally across the board in many of the US stocks. since last April when we had the Liberation Day drop. So we think caution's very warranted here at the moment, and maybe just taking some profits out of the last year is more than warranted.
That's Mark Gardner there, the CEO of MPC Markets, and he wraps up the podcast for this Monday. Give it a like, a review, and subscribe if you enjoy it. Don't forget you can watch the On the Money segment during the 6:30 weekday edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close every day, and I'll catch you there. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.